Okay, let's dive into this. Today, we are unpacking something that is literally the lifeblood of any organization. Yet, it's kind of treated as an afterthought way too often. We're looking at the foundations of business finance management. Over the next few minutes, we're going to entirely demystify the life cycle of a business's money, where it comes from, where it goes, and most importantly, how to keep it growing securely. So if you're a focused learner wanting to figure out how the financial gears actually turn behind the scenes of a successful enterprise, well, you're exactly in the right place. Now, to really get why this is so critical, just think about a scenario that happens way, way too often. On one side, you have a company that's highly profitable on paper, but they are constantly struggling with debilitating cash shortages. I mean, how does that even happen, right? Well, without proper diligent planning, even the most lucrative companies can face some serious and sometimes fatal challenges. But on the flip side, we have long-term growth and success. The bridge between those two drastically different realities, that's our main subject today. Smart, proactive financial management. It really is the ultimate hero in business. So here is our roadmap for this explainer. First, what is business finance? Second, planning and acquiring capital. Third, investing your funds wisely. Fourth, the power of cash flow. And finally, maintaining financial control. We're basically going to walk through the chronological journey of building a company from the ground up. All right, section 1. What is business finance? The blueprint for operations and growth. At its core, business finance is the process of planning, acquiring, managing, and controlling the money needed to operate and grow a business. And notice I said process. It's incredibly dynamic. Think of it kind of like a giant plumbing network. Money flows in from outside sources, like external investors or banks, and it absolutely doesn't just sit in a vault somewhere. That money flows actively through the pipes directly into your daily operations, your employees, your marketing campaigns, and your production lines. It literally acts as the circulatory system for the whole shebang. And here is exactly why this matters to you. Implementing good financial management helps you do 4 vital things: maintain cash flow, reduce risk, invest wisely, and ultimately achieve long-term growth. Having this strong structure ensures that every single department in an organization has the actual resources they need to hit those big, ambitious business goals. Because let's be real, without strong financial management, your marketing team can't launch that awesome new campaign, and your product team can't even source materials. Every single thing relies on this foundation. Moving right along to section 2. Planning and acquiring capital. Getting the money you need. When a business actually sets out to get funded, it goes through a timeline of 3 sequential functions. Point 1 is to estimate requirements. Before you can even think about asking for money, you have to determine exactly how much you actually need. You've got to forecast the cash required for your current daily operations, any expansion plans, and future strategic investments. It's all about knowing your exact financial target right out of the gate. Now, what's really interesting about this slide is that deciding your capital structure is a massive strategic decision. It is all about finding that absolute perfect balance between the 2 slices you see here: owner's equity, which is the money from founders or shareholders, and borrowed funds, which is just your debt. The whole goal here is to balance these 2 elements so you minimize your costs, like those pesky loan interest payments, while maximizing the total returns for the business. Which brings us to point 3, selecting sources. Once you know exactly how much cash you need and you've nailed down that debt-to-equity balance, where is that money actually coming from? Your main sources of finance include things like traditional bank loans, bringing on outside investors or venture capital, utilizing retained earnings, which just means reinvesting your past profits back into the company, or issuing shares on the stock market. And listen, selecting the right sources from this list, it's not just some basic bookkeeping task. It's an absolutely critical strategic maneuver for funding your blueprint successfully. All right, section 3, investing your funds wisely, maximizing returns and growth. So the funds are in your hands. Now what? You have to invest efficiently to generate the highest possible return while supporting growth. You definitely do not just hold on to the cash. You've got to pour these funds straight into the engine of your business to generate maximum value. That means purposefully investing in building new factories, upgrading internal technology, hiring top-tier employees, and funding aggressive, targeted marketing campaigns. But we have to recognize that not all investments are exactly the same. On the left, we have those core business investments we just talked about, the funds directly running your day-to-day operations and physical growth. But what if you have a totally killer year and end up with extra cash? That brings us to the right side, surplus funds. Any extra cash must also be invested super wisely into savings and investment accounts instead of just sitting around unused. Unused cash isn't creating value, right? It has to be managed strategically so it keeps working for you behind the scenes. Okay, section 4, the power of cash flow, managing daily operations. Healthy liquidity. This is huge, guys. Managing your cash flow is absolutely essential. In any business, you constantly have money coming in from customers paying invoices and money going right back out to cover payroll and suppliers. You have to meticulously manage that timing to ensure enough actual cash is actively available on hand to meet your daily expenses. You can be immensely profitable on paper, but if all your money is tied up waiting on unpaid invoices and you lack healthy liquidity, there is no way you're paying your employees on Friday. Managing cash flow is literally your daily survival tactic.
Finally, Section 5, maintaining financial control, keeping everything on track.
This final phase is all about crucial oversight. Your financial control objectives are to rigorously monitor income, expenses, budgets, and overall performance. Basically, you're using specific financial reports, audit checkmarks, and KPIs to verify that your overarching business objectives are actually being achieved efficiently. It's like the dashboard of your company, right? It lets leadership know immediately if things are running smoothly or if you're starting to drift off course. Let's move to and see how this builds all together. Here are the 7 functions we've covered today: estimating requirements, deciding structure, selecting sources, investing core funds, investing surplus funds, managing cash flow, and controlling finances. These form the absolute ultimate pillars of business survival. Together, they represent this continuous, dynamic cycle that is, for sure, the single biggest driver of long-term business success.
So, what does this all mean? I want to leave you with a final, provocative thought. Is your business just making profits, or is it truly managing its financial resources? Remember that profitable company at the very beginning that still struggled with fatal cash shortages? Yeah, don't let that be you. I strongly encourage you to rigorously evaluate your own financial management lifecycle against the blueprint we just explored today. Take control, stay liquid, and plan for growth. Thank you so much for diving into this explainer with me, and as always, keep learning.